So let me go to Reza, and I'm asking each of our distinguished guests to try to make only their key points so that they can interact with each other. If each one gives a full opening statement, we're not going to have any time for interaction with each other or the audience. So, but Reza, we do want to hear what you have to say, please.
Thank you very much, Adam. I think I can be fairly brief because I do not really have many issues to pick on what Jean has presented. Maybe there are questions of emphasis. But before I start with a few points, let me just pay tribute to Jean. I think I've seen throughout my work on Europe that under his leadership, Bruegel has really become the premier European think tank and research center. So given that I know he will be leaving Bruegel shortly, I thought it's important for us to pay tribute to what he has done with Bruegel. But let me come to some of the points. I think in terms of the broad setting and the analysis of the initial conditions that you put forward, I think it depicts, from my perspective, a very accurate picture of the challenges and the difficulties and the setting, which are much more complex than in the normal IMF program settings that we are used to. So I have no issue to pick in terms of the picture you depict at the outset of this program. But let me just point of emphasis. I think probably some of the complications of the situation are somewhat underplayed, and let me give you for a few examples. I think one came out, which was the financing needs of these countries. Two, I think, which I would say you mentioned as a success of these programs, but it was also a huge constraint of these programs, where the fact that you operate within a monetary union and a very strong monetary union in terms of the political setting, and that's the issue I want to underline. The governance structure of decision making within Europe is very complex. And I think throughout these programs, I have come to realize just how complex they are. Just give you some examples. For example, if we reach an agreement with a country, we simply agree on the financing and then recommend it to our management, and it goes to the board. You have a simple decision-making governance structure. In Europe, that's much more complicated, and it has been although the design has evolved throughout the crisis, it remains a very complicated process. I mean, for example, look at the design of ESM. It is a safety net that can be used during the crisis. It is being used, but the approval of each tranche, not just a loan, each tranche for each country essentially has to be done by each member of the Eurozone through its own political process, and some of those require, of course, each time going to Parliament. So it's a complicated political process. Financing needs. I think just to give you a simple example, since the second Greek program was put in place, Europe, not the fund, Europe has put in 130 billion into an economy of less than 200 billion. For the fund, it has been 6-7 billion. So the financing needs in these circumstances of a monetary union, with obviously what Jean showed in terms of the magnitudes of financing to keep the member countries within the euro, the magnitudes of financing are enormous. Another complication which I think was overlooked. In almost all the cases, the countries asked for help too late. I think go back and look at the run-up to each of the programs, And to me, the problems would have been if the problems had been dealt with at an earlier stage, the problems would have been easier to deal with. And we see that in almost every case. Look at the latest case of Cyprus. So now that is for two reasons. One, the countries themselves were underestimating the degree of the problem they faced, and they also had political problems to ask for help, but also the decision-making process, the governance process within the Eurozone compounds that difficulty. Let me address two other issues and I stop, Adam. One, some of the issues that Jean raised about the fund, and then I'll briefly address some of the issues on Greece. About the fund, should it be in, should it be out? In a way, we are a cooperative institution. It is the member that asks us to be in or out, and in this case, of course, the member has to have given the political constraints and agreements within Europe, it has to have the approval of its European partners. The question is not whether the fund should be in and out. I think the question is the conditions that the fund would require for it to have a financing program. And that comes to the conditionality, the availability of financing, and also, I think, one point that the fund has brought to the table from the very beginning, the focus on debt sustainability within the Union and the constraints that imposes and the policy implications that requires. This issue of equality of treatment, I think it's an important issue to focus on. It is an issue also I feel quite comfortable about for two reasons. One, actually what has happened. Each one of these programs was approved at the board unanimously. Every member of the fund voted for it. And every review we have had since the beginning has been almost unanimously, not always unanimously, but pretty much close to unanimous approval. So I think if there were concerns, you would have seen it in that process, and we did see it in the previous crisis. We haven't seen it here. The issue of resources, I think given the governance structure of the fund, the fact that we are a very rules-based institution with very clearly defined policies that are approved by the board, I am not too worried whether we lend 1 penny or 1 billion. I think the way the fund works, the rules apply, and the one that Jean mentioned in terms of the threshold for exceptional access, and that was amended. We transparently amended a rule which said to give exceptional access, you have to have a high probability that the debt in Greece was sustainable. We transparently told people we did not have that comfort, and therefore to have that comfort, it required a change in the rules to introduce this concept of systemic implication. I know I've run out of time. Maybe I'll come back to the other issue later. Thank you.
Yes, thank you very much, Reza. I know that you've all got so much to say, but I want to make sure everyone gets their chance. Obviously, these issues of benchmarking to other programs in the past and other types of IMF programs is very important. Servas, please.
Thank you, Adam, and let me first thank the Pension Institute for the invitation. I'm also grateful for the opportunity to provide my comments on this premature, I know it's a very early evaluation of the programs. Two introductory comments to start off. One is, you will certainly understand, I cannot be neutral in this debate. I have been the mission chief for the first program of Greece, and I have been heavily involved in the design of the other programs.
That's why we asked you.
Well, that's also complicating my task. Second introductory comment is that hindsight is always 20/20, as the saying goes in the United States. By this I mean that proper evaluation has to take place in the historical context. And many apparent truisms today turn out to lose their value when they are put into the historical context. And that's part of the problem I have with the analysis of the Brugge report, and I come back to this. I would like to focus on 4 broad themes. I know I have no time, so I will have to be very quick and very selective on the uniqueness of EMU, policy conditionality, country experiences, and governance issues. The first point on the uniqueness of EMU, I don't have to add much to what Jean and Reza has told. The setup of the paper is correct. It depicts very well the challenges in EMU. But 2 comments. One is that we have all been learning. Not only the Commission, but also the IMF, I would say Bruegel, all scholars have been on a very steep learning curve. I was at the Macro Policy 2 conference, where at the use Olivier Blanchard's statement, navigating by sight is what we are doing. And to some extent, it's true that if you have to develop these programs for these countries, which are completely different than before, as Reza has said. So programs in the euro area are also not the IMF's daily bread. Combining fiscal consolidation, competitiveness issues, and the leveraging is a huge task. There is no economic model available, and so a lot of judgment has to be called in. So that has to be taken into account when the assessment comes later on. Jean has indicated the monetary union requires separate policy conditionality with a major role for structural reforms. That's correct, but then it's very hard to understand the criticism that the programs has been too detailed on structural reforms. Given that we don't have the monetary policy, no exchange rate, the adjustment has to come to structural reforms, and that is undercovered in the report. Last point on the challenges, as indicated to some extent by Jean. For Greece, we had to build a boat during the storm. Nothing was available, no institutions were there, we have no instruments, and so we have to develop the framework on the go, and that, of course, is difficult and has also, to some extent, perhaps led to some delay in a number of elements. Let me move on to the policy conditionality, and then also address a number of elements that Jean would like us to do differently. One is fiscal consolidation and the front loading. Here I would beg to differ with the report. In my view, major front-loading of fiscal consolidation was inevitable in Greece, in Portugal, and also in Ireland, but to a much lesser extent, for different reasons. I have no time to go into that, but front-loading was necessary, given the size of the fiscal challenge, given the risk to sustainability, given the problems with the financing envelope, but also, and even more importantly, given that we have to act in the face of very extremely different markets, which without fiscal consolidation or upfront fiscal consolidation, it's quite likely spreads would have gone higher, contagion in the Eurozone would have been much higher than otherwise would have been the case. So I do think that this is an element which is again, not sufficiently well estimated in the report. Second element, structural reforms, as indicated, they are of paramount importance. It's very hard to pinpoint the exact timing and the effect of structural reforms on the economy. I would not agree that we have overstated the short-term impact of structural reforms. I don't think that is the case. What happened is that quite likely we have underestimated the negative impact on potential growth through the crisis, the balance sheet, structural transformations of the economy, which has led that even if we had a V-shaped recovery built into the programs, it is much more because it was a very strong contraction. You get a kind of a cyclical rebound, but potential growth was less than otherwise would have been the case. Having said that, if structural reforms are there and are implemented, it should then also be reflected over the medium term into the DSA analysis. Structural reforms are not for the short term, but they are for the medium and longer term, should have a major impact on growth going forward. Last element on the conditionality is the deleveraging, and I guess here that was the most difficult part in the programming, how to calibrate and have consistent bank deleveraging and macroeconomic adjustments. I do think that potentially the dearth of liquidity, the absence of confidence in the banking sector, delayed, backloaded bank restructuring and recapitalization is a problem. So I see that my time is very short, so I have to skip quite a lot. A word on Greece, on the forecast. I do think that, as I indicated, just comparing outcomes, with projections is flawed to a large extent, given that there has been so much external factors on the political nature coming into the program that has deviated quite a lot the program. If you look into the program outcomes, and during the first 18 months, the program was fully on track on the macro side. It's only when the political difficulties came with PSI, Brexit, and all the other things, then the program derailed. I have no time to go into all of it. I have issues on Ireland with the bailing in. I do think that the issue of bailing in is not properly represented. I don't think that bailing in for Ireland would have been a solution. The same for Greece, early debt restructuring. The report goes into why it has not been done. I would also take issue, and I guess I would have appreciated if the report would have gone deeper into that, to what extent the PSI, the debt restructuring that we have seen, to what extent it has been beneficial. It has been extremely expensive, and it has also led to further problems in the banking sector and to higher financing needs. Let me skip all other things and just have a word on the governance issues. In my view, and let me stress a number of issues, the Troika formula is working well. In general, there has now been major divergences among the Troika. On most of the programs, there has been a few hiccups. We have to take lessons from that, but the Troika has functioned well and is bound to stay in the future. As regards the role that Brugger reports to the IMF and the Commission, I do think that the report oversimplifies. Neither institution is vertically integrated, free of conflicts of interest, and fully independent. The broader competence of the Commission has not led to conflict of interest and have helped to implement the program on the contrary. I also do think an issue which has not been highlighted enough, there is a difference between the IMF and us. IMF has a much more country focus in the surveillance and in the programming. They are really focused on the country. If there are problems for another country, they say we give a program to the other country. While in the Commission, we have much more paid attention to contagion and spillover effects, which has led to different solutions now and then into the program. Last point, if you allow me 1 minute, is on the role of the Commission as Jean has depicted. In his slide now, he depicts two potential future roles for the Commission, either giving the Commission a kind of an IMF role in the same elements, or to move the ESM into an EFM type institution going forward. I would agree with Jean that the first one would potentially be optimal, but I don't think that it's in the cards in the near future, given that other decision has been taken to the contrary. So I don't think that it's a big chance to think about this issue. On the other hand, moving the ESM into EFM type has also a lot of difficulties. The ESM is not an institution, EU institution. It is only, if you understand correctly, it would only be in charge of program, but what do you do with all the rest of the surveillance? So we cannot have an institution in charge of macro surveillance for the good times and to have an institution for programming for the bad times. I would have major difficulties how that would fit into the whole policy setting going forward. And last but not least, as the ESM is an intergovernmental system, there is major risk of conflict of interest, and also the independence of the analysis could be highly questioned. Thank you.
Thank you. I really appreciate, Servas, you're trying to cover so much ground. Let me make an open offer to all our panelists. If you have longer remarks you would like us to post along with the video and the transcript of this event, we are happy to do so and distribute them immediately following the event. Jörg from the ECB.
Yes, thanks. Adam, let me first thank the Patterson Institute for hosting us here and creating a platform to exchange views on this report. I'd like to thank Bruegel for their academic report they have provided. It will not surprise you that I do not share all elements of the report. I think Servas has covered a lot of ground why the methodology when it comes to the first part of the report, which has an assessment of the program design and the outcomes, why we think some of the methods chosen are not correct one. Servas mentioned rightly that one should not simply compare outcome of programs with projections of programs. I'm not sure if it's very wise to simply benchmark programs of the Euro area countries or some Euro area countries with an average IMF program, like the ones quoted in Asia or in Latin America. I mean, then I would have benchmarked against other programs in Europe, like the one in Latvia or in Romania or whatsoever. This is closer to our institutional setting. Or if one would have taken account of the indeed specificities of a monetary union, which Reza and Servas alluded to rightly, then one could have looked at fund programs in Africa, where some countries, yeah, they are not advanced economies, but at least you have an institutional setting of a monetary union that one could use. The definition of a success of a program, I think it's difficult to look at the adjustment trajectory and say unemployment rises in the path of adjustment. There's a clear definition for success of a program, that a country exits and has the chance to finance itself on the markets. So this is what we have to look at, and I think especially if one look at Ireland, we are close to success. Portugal is well advanced, and Greek indeed is, as you rightly say in the report, is the most difficult situation. I think when one looks at the criticism of the program design, I think one should keep in mind what was the information available at the negotiation stage of the program, and what were the available alternatives when the program was decided. So it's easy to say, and I think many of us would agree with the knowledge of April 2013, that maybe an earlier debt restructuring PSI for Greece would have been advisable, but that was simply not feasible when the program was negotiated. Also, involvement of senior bank bondholders in Ireland. With the knowledge of today, this will become a standard setting of bailing in. With the knowledge of that point of time, that was simply not in the cards. It was unknown to financial markets, and it would have given severe concerns regarding financial stability. Today, this is different. If markets are prepared, if you start to set up a legal framework about bailing in, that investors know ex ante what they're up to, this is very different. So we can agree that if one looks backward, one always designs programs differently. But one has to be fair and say, when were the programs designed at that point in time? Also, one should be more clearer what was the political reality. I mean, there was one chart saying, oh, it might be good to have less austerity and more financing. I mean, the countries had lost market access, so financing was not available via markets. So it then is only available if someone else gives a loan or a grant. And was it realistic to have higher loans or even grants? No. So then you have to have fiscal adjustment if you have lost market access and there is limited willingness or availability from financing from other partners. Looking at the assessment of the Troika that you have in the report, and then finally at the policy recommendations you give. I think that the Troika has really worked very well. And if you say that the Troika had differences inside, I mean, these are differences that you normally have inside institutions. I mean, everybody who knows the fund a bit better knows it's not a homogeneous institution. The EU Commission is neither. Of course, the ECB is, but normally you have this somehow different views, maybe between institutions, that you have otherwise inside an institution. So I would really strongly recommend to continue that the Troika works. One can look at different settings 5 to 10 years from now, because the crisis management was developed in the midst of a crisis in Europe. And I would not change this, because I think it has worked pretty well. We can look, and I will do this later, at the longer term setting up on how we deal with these things in Europe. I think every institution has brought its specific knowledge to the table. It's the fund, they have a unique global knowledge in program design and in technical assistance in some areas. It was the EU Commission with its knowledge about fiscal policy and structural reforms. And it was the ECB with our knowledge on the financial sector and macroeconomic questions. So if you put this together, I think this has worked pretty well. And there are various publications. Even yesterday, the Financial Times had an article recommending the fund to pull out. The Handelsblatt at the same time had a report that the fund should be stronger in European programs. That we are all criticized for the program design. That's, I think, part of the process. I would remind you where the word troika comes from. In Russian, it's a sledge that it's pulled equally by 3 horses. And if you take one horse out, the other 2 have to work harder. So I would not do this in the situation which we are in right now. I think the ECB is there because we give advice to member states. That's part of our mandate. This is because member states trust us, and it does not interfere with our independence. And I mean, when the report says it's difficult to assess our role, I quote now, because we publish little or nothing about our involvement in the programs. This is because we have not to duplicate what, say, especially the Commission does. There are many reports written by the Commission in liaison with the ECB. So this can be seen as this. And I think we are sitting on the right side of the table because we provide partly massive liquidity to the banking sector of the countries. On the other recommendations, I think the report suggests somehow that the fund should restrict its role in programs. I think it's difficult because still member states are members of the fund, so they have a right that the fund intervenes, and I think the fund should stay with us in Europe. It's an extremely valuable instrument to have a global institution being involved in this. 2 final points, Adam, then I finish. On what you think how the ESM should develop, I think this could be a very long-term perspective. My personal view is you cannot make the ECB accountable for this, is that one should move the ESM, which was set up because there was simply no alternative under the constraints the current treaty gave to us, into a normal community institution. Could be a community of the euro area. I mean, the advantage of the ESM, it's the first real institution that the euro area has, because even the ECB formally is an institution of the 27. And I'm deeply convinced that the core of the future integration is the euro area, so we need to develop our own institutions. Majority voting at the board of the ESM, good idea, talk to the member states. And I fully agree, finally, that there is an accountability issue. So if one would move the ESM into a communitarian institution financed by a kind of euro area budget, then one should be accountable to a parliament, a European Parliament, in the same way. So I think this is a good and step for the future. But to finish, for the time being, in the midst of the crisis, I would keep the institutional setting. This has worked very well. Thank you.
Thank you very much, Jörg. This is, again, thank you for being willing to constrain your remarks, and again, we're willing to publish the broader list. I think it is a good topic, perhaps for this institute as well as for Bruegel, to think about the proper benchmarking versus other IMF and other conditionality programs. And if a troika is good enough for Russia and the EU, maybe everybody else should have a troika too. I don't know. Jacob, what do you think?
No, thank you, Adam, and thank you, Sean, for this report. Well, I figured I should just give some brief remarks about. I don't actually have much to say about the report. I like the conclusions in it. There's not much in it I disagree with. So, what I thought I should focus on were some of the things that the report does not focus on, because by nature it obviously cannot cover everything. So. The first thing I want to talk a little bit about is simply the political circumstances surrounding the size of these programs. As Sean mentioned, they are unprecedentedly big, both arguably from the perspective of fund lending, but also when you add in the 2/3 from the euro area. And that size has, I think, significant caveats attached to it. Because it means that the funding provided by the euro area has to have had parliamentary approval, simply as a matter of the size of the amount of money involved. And I can't help, I can't resist also noting here that, when we go back to the Mexican program in 1995, the bilateral U.S. contributions to that program came explicitly outside the jurisdiction of Congress because you wanted to avoid congressional scrutiny and other issues. I know, Ted, you're sitting there and...
Ted,
all right.
Stop. If you can prove him wrong later in writing.
All right. I stand to be corrected. But the point being, the broader point about the program from this parliamentary scrutiny, inevitable parliamentary scrutiny simply from the perspective of the financing involved, it actually adds a lot to the already extreme complexity that Reza mentioned in the euro area, because it inevitably lends these programs to being hostage to the political calendar of Europe to an extent far beyond regular programs. And I think that's unfortunately an unavoidable outcome simply because of the size of the programs. It more importantly also, I think, gives rise to and at times excessive concern with moral hazard that comes from this type of parliamentary scrutiny. Which means that when you, for instance, think about, well, why was it that the initial bilateral loans granted by the euro area to Greece came with extremely high interest rates? Well, I think it can be traced back to the need to pass these loans through various national parliaments. It also means that when you think about the timing at which concessional lending can occur, or even, shall we say, stealth fiscal transfers like maturity extensions of loans already granted, it tends to happen only at the end of a program, like what we saw just last week with Ireland and Portugal. And again, I would argue that this has to do with the need to limit moral hazard, again, to secure parliamentary approval of these programs. And so there is, if we think about Greece, for instance, which I would argue is a country that clearly needs further debt relief to ever have a chance to return to markets and therefore have a successful program there, this type of debt relief will not be possible in Europe because until the very end of the program, because of these parliamentary approval concerns. Finally, I guess it should also note that when we think about the potential for IMF collaboration with other regional entities perhaps in the future, I think it's fair to say that the European experience and the need for parliamentary approvals here suggests that any fears that regional institutions, for instance in Asia, the Asian Monetary Fund or something like that, were to at any point in time be willing to lend at more concessional rates than the IMF to a country in crisis, clearly is a highly unlikely event. I think clearly that's one of the lessons from Europe. The second point I think is worth highlighting, and the report does this to a large extent, although perhaps not quite as much as I would have liked, is to really focus on the starting point of these programs. I mean, not only are they very large, but the initial imbalances are also very, very large, whether you look at the internal, the external, the size of the banking sector, or even the structural reform deficit, if you like, in some of these countries. Now, whether that is that's partly due to the fact that they are a member of a currency union, it is perhaps also because they are, advanced economies, which until this crisis were perhaps given more leeway by markets than traditional IMF program countries. But what it means is that the shock of adjustment inevitably will be much larger, simply because the larger initial imbalances that needed to be corrected. And I think that has very significant implications for the validity and therefore importance we should attach to fund forecasting for the economic development of these countries. I simply think we need to be a lot more humble with respect to our ability to project the future economic developments in these countries, whether it is unemployment, domestic demand, or other issues. And therefore, I think a lot of the criticism that has been leveled against the Troika for missing or for being wide off the mark with their initial projections for Greece, for instance, first and foremost, I think is largely misguided. But I think it also has the implication that we need, therefore, in light of this uncertainty, to recognize that legal documents like the IMF debt sustainability analysis is really to be, in my opinion, viewed appropriately as largely political documents. We should not attach particularly importance to what it means to have, 100, or the validity of an estimate that says 120% debt to GDP in 2020. Because in an empirical sense, I think that given the uncertainty, that is frankly a largely meaningless estimate. It serves a very clear legal purpose at the IMF, but I think it shouldn't mask the fact that conditionality attached to these countries should really not be based upon what this conditionality may or may not do to the debt sustainability analysis in the nth out year, because the uncertainty surrounded with any such forecast, but rather whether or not we frankly the Troika likes the individual measures that have been agreed to be implemented by the national governments. This is obviously a much more political assessment than a sort of macroeconomic-based forecast that the debt sustainability analysis lends to. But I do believe that that's very necessary to keep in mind, especially for these programs. And then I'll be...
Time.
All right. Very quickly, I'll just skip a few things and go to the institutional forecast or suggestions by I think I very much support keeping the IMF involved in these European programs. But I think we need to also recognize that as the institutional arrangement in Europe continues to evolve, that must have implications for the Troika. I, for instance, find it very hard to believe that the ECB can continue as a full member of the Troika once it becomes the responsible for banking regulation in Europe. I also find it hard to believe that the ECB can be a member of the Troika for an OMT program to the extent that a Troika for such is needed, since the ECB reserves the right to an individual assessment of that program. I support the proposal for an European Monetary Fund based on the ESM by Sean and his co-authors, but I just think we need to recognize that that requires a major treaty change in Europe so that it is not forthcoming. Thank you.
That's it. Sorry. See, this is the one disadvantage of a troika. It means if we give fair hearing, we've got too many people talking. I'm going to open it. Yeah, I see you, Jose. I'm going to open it up to questions. As usual, I'm going to ask that the first 2 or 3 questions or comments be from people outside the Institute, not Institute members. There should be a microphone coming in at the front. Jose, you want to go to the microphone and back, and you can go first. Please identify yourself.
Jose de Gregorio. I think that I haven't read the report, but I like a lot the presentation. I think that is fine. The Troika, it seems that did well in terms of designing the program. However, I have concerns and serious concerns about the governability and the implications for future workings of the international financial architectures. Just 3 points that...
Not
Jean
3 points,
mentioned.
Jose, just 1 point.
3 points that Jean mentioned.
No.
Is the programs are large, for fiscal reasons without sustainability, and central bank and finance ministers at the creditor side. So I think that this is absolutely unusual. And Reza said, well, we feel comfortable in the staff because this was approved unanimously. I worry about unanimity because in the future, the voting history matters for future policy decisions at the fund. So I think that I was thinking about the Asian crisis with this precedent, or if something happened in Latin America. I think that this has a lot of implications, and we need to think more about how to really structure the international financial architecture so we don't have this permanent changing rules and how we work for solving the problems of other countries, not just Europeans.
Thank you. Reza and John, do you want to respond to that?
There has been hardly any rules change in the fund throughout the crisis. The only thing was the very minor point that John raised. So the framework is essentially the framework which emerged after the Asian crisis and was revamped after the Asian crisis. So our rules have not changed.
Okay. John, unless you have something, you'll pass. Gentleman here, please identify yourself.
Thank you. I'm Arturo Porsikansky with American University. I just want to encourage John and his co-authors to cite some examples, because there are plenty, where European leaders became their own worst enemy. You mentioned, Reza, why didn't they come to the IMF earlier? Well, because there was a view coming out of Paris in particular that, you know, we can take care of it ourselves. And that cost terrible time and eventually money. There is the view that, of course, when there is no financing, the choices are between adjusting and what the official sector can provide. Yes, but confidence in the financial markets was destroyed by statements coming out of political leaders and decisions made. So it's not so simple. I hope you will cite some examples where the cost was needlessly high, financial and otherwise.
Does anyone want to save that? I will just say, the microphone should go to Uri, to the gentleman behind her. I will just say that the idea that I obviously we're all aware of what certain officials from the ECB and from certain member states said about the IMF at the start, but I think we're all also aware, in the spirit of what Jose was saying, that it's very rare for any country to go to the IMF or ask for a program in good time in any situation. Uri, and then we'll put it, we got a lot of people. So I asked the people in back if you could line up at the microphone, please. Yes, Angel, after the third question, you can get in line. You'll get to you in a second.
Yeah, Uri Dadush with the Carnegie Endowment. So my biggest worry is that we're a little too positive on the outcome of the program. In particular, the fact that Portugal and Greece both have seen, according to your analysis, very little improvement on the export picture. Yeah, only in Ireland do you see the big significant improvement in the export picture. Raises the question of where the growth can possibly come from in these countries, and until we have convincing evidence that the exports are beginning to pick up, the adjustment that we're seeking.
Can you phrase it in the form of a question, Uri?
No, it's just not convincing. So, you know, what do you think about that?
Thank you. See, a man who takes direction, I love it. Since this is about structural growth, why don't Servas or Jean come in on this? You don't have to, you can decline. I'm just offering.
Very short on this. On the export side, let me just remit to Greece on the exports. You have to remember that the export sector in Greece is extremely small, very small. It's a relatively closed economy. So if you want to have a major boost from that, you have to have a major improvement in competitiveness, and even then the impact macroeconomically will not be there. So what is necessary is, through the structural reforms, internal demand has to come up over time. And that was the whole problem. I cannot explain all of this, but that was the major issue in how to calibrate the external side with the bank deleveraging and fiscal consolidation. So how to get this picture right, that is the major issue that the program designers face.
John, do you want to say something?
Yeah, I'd like to take a broader point that was also echoes some of the discussion. There was a contradiction in those programs about the fact that on one hand you wanted the nominal GDP to grow for reasons of debt sustainability. On the other hand, you wanted the GDP deflator to decline for reasons of competitiveness. And that's the core issue of adjustment in a monetary union of a country that starts with a very high debt level. And this issue, there hasn't been any good solution found to it. Let's face it. And so in the program, I mean, there was too much of an optimistic assumption on the fact that the reduction in domestic demand would free capacities that would naturally find their way to world market without changing the real exchange rate significantly. And that did happen for Ireland. It did not happen for the other two countries.
Okay, I'm going to give an order to this. Lee, Angel, then Barbara in front, and then Ted in back. So Lee.
Lee Price from the FDIC. I assume that the Cyprus situation came along too late to be much in your report, so you didn't talk about it. But I have two questions. One is
That would really be preliminary, or what was premature. I think we could go.
But I have a couple of questions that I don't think are premature. One is, how did it happen that the Troika decided that depositors less than 100,000 euros should take a huge hit? And secondly, what are the lessons that you would draw today from the Cyprus situation that we haven't discussed yet?
Would anyone care to answer that, or is it a little too premature? No, Jacob, I'm sure you can answer, but I want to see if somebody from the official sector wants to. If not, then we'll let you have your shot. Okay, Jacob.
Well, I mean, I'm just sort of like, it's the Bismarckian sausage, right? I mean, don't look at the process, look at the outcome. And I think the irony is that if you look at the process fiasco, if you like, it actually means that I think in political terms, the insured depositors in Europe are probably safer than they have ever been as a result of this. No policymaker in Europe, in my opinion, is going to want to go down that route ever again. And I think that if you look at the most recent statements coming out of Brussels and Frankfurt and elsewhere, I would suggest that that there has been some movement vis-a-vis the relative importance of having a genuine joint resolution and deposit insurance fund. Partly also, I think, prompted by the need for this in the aftermath of Cyprus.
Thank you. You can now see why not only the Institute, but especially Jacob, is known as the European Union's best friend in Washington. Angel.
Angel Ubide from the Shaw and Peterson Institute. If my memory is correct, the assessment of the Asian and Latin American programs from the fund was you need to use overwhelming force. Now, to me, it looks as if this lesson was unlearned for the European crisis, because every program at the end of the day was underwhelming. And it was underwhelming because there was no conditionality on the European response. The design of the EFSF ESN was always too small to be enough. There was no obvious conditionality on the policy mix that needed to be put at the European level, because at the end of the day, Greece and all of these countries, they did have a monetary policy that was driven by the European Central Bank. And so when you make an assessment of success, I don't think the success is return to market. It's return to market at the least possible welfare cost. So I don't know if this is in the report because I haven't read it, but Jan, if you have any view on that, I think you went a bit light on the guilt that the European part of it may have, and if any of the other participants have anything to say. Thank you.
Thank you. Yeah, please.
Well, in a way, I agree. I mean, that's the point we're making about the availability of financing and the set of constraints under which those programs took place. Someone asked about what was the worst decisions. I mean, you could mention many, but ultima ratio was probably one that you only had to access at the late stage at penalty conditions, etc., which was exactly the contrary. The philosophy was exactly the contrary of this sort of overwhelming program approach. So the question is to what degree you internalize those constraints. That was part also of the reaction there were at this table. We're fully aware that you can blame the Troika, you can blame the European setup, under which, within the framework of which the Troika acted. I mean, to say the least, the European setup was far from optimal.
Unless someone from the Troika wants to comment. Okay. Barbara, please.
Thank you very much. I look forward
Could you
to...
identify yourself, please?
Barbara Matthews with BCM International Regulatory Analytics, but for purposes of today's conversation, formerly U.S. Treasury Attaché to the EU. And that colors what I'm about to say. I look forward to reading the report. I think that, and I hope it covers something that Washington really tends to underestimate, which is the amount of radical institutional structural change that has been happening on the fly in Europe to date. And that leads me to my question. As you look at the pressure to focus on unemployment, as you look at the pressure to comply with a secular shift in central banking that is looking more at unemployment for monetary policy purposes, do you worry that it's going to undermine the ability of the IMF or any external agent in the future to come in with the overwhelming force that Angel suggested? I mean, part of the institutional infrastructure since 1945 has been to take some of the ownership away from the national country receiving money in order to ensure that, in fact, political resistance can be overcome. I worry about this tension going forward. I'm wondering, do you worry about it either at the IMF level or in Europe or both?
If either Reza or Jorg would care to comment, please.
No, I mean, I just have to, in order not to create any kind of confusion on news wires, to correct what our mandate is. So otherwise they'll say I'm silent on this. We have a primary objective, this is price stability. This was given to us by the European leaders and European Parliament, so they can change the mandate. But I think we have a good mandate and we work on this, so it's not right. We have a different mandate, than the Fed, so for us price stability is the key and primary goal, and this remains unchanged.
Thank you. Having just testified on this on the Hill yesterday, I would suggest that the Fed hasn't undergone any major secular shift either. It's got a proximate target while inflation is very low. That's different from a shift in goals. Sorry, Randy. Ted Truman, and then I'm afraid I am going to have to cut it off because we're already, I believe, 6 minutes past our time. It'll be 10 by the time Ted
Thank
goes.
you, and you can be assured, Adam, that I'm not going to have my correct Jacob about what he's saying about
You're free to correct him, just not right now.
I am not going to. My question actually comes back to, and this is principally for Reza. We've all been watching this drama from outside, right? And in my view, the drama from outside has created the difficulties in Europe, which are not unique for any crisis. There's nothing substantially different by the European crisis than any other crisis we've seen. The problem, I think, is that it has been addressed as a country-by-country crisis, Greece and then Ireland and then Portugal, rather than a European crisis. And we have been unable, this is the question, and maybe we should have, at the fund, address this as a European crisis with European-wide solutions on the fiscal, the monetary, the structural from the beginning, right? You could even argue that how does the IMF, is it legal under the IMF to have other countries veto going to the IMF? So there are real issues about the role of the fund and these countries in the fund, it seems to me, and the way the fund has been constrained, but that's the question going forward, to say this is a country-by-country case and this isn't the euro area because, the euro area is so special. We have our own structures, and therefore the fund in some sense can't muck with our structures. So I think Reza should comment on the fund part, and maybe someone else, please.
Yes, Reza, should you comment on the fund part?
Yes, and I think it's a very good question, but it's also a common misconception that is being put forward. I think on every issue, almost every issue, which goes beyond the borders of the country, the dialogue that we have had is not just with these two gentlemen, but the dialogue has been with the key European capitals and with the groups of Eurozone members, particularly the Eurogroup. And I think the dialogue has taken place on two levels. I think on the very last weekend in Dublin, on the very day that the individual programs were being discussed, the architectural issues regarding banking union and direct recapitalization were being discussed. So I think when you see it, maybe not from here, but when you are involved with the programs and with Europe, you see a dialogue taking place not just about Greece or Ireland or Portugal, but about what those mean for the architecture of the Eurozone, and what it means for supporting that architecture, supporting the monetary union going forward, and therefore I would argue growth going forward. And I think it goes even beyond the architecture. I think if you look at the debate on fiscal policy, I think everybody is aware of the issues that we have been pushing, particularly, for example, the focus on structural adjustment rather than headline. You see those shifting as these programs have developed. Even on the ECB front, I think look at the measures that have been successively taken, from changing the collateral rules for the program countries to SMP to OMT. I think there has been pragmatism, and that has been brought about by looking at individual experience, but acting at the Eurozone level in terms of changing architecture and changing the way things work. So I think I would say it's a good point, but I would say it's also a misconception that it's not happening. And the role of the fund in terms of pushing it. At every stage, these gentlemen could testify, we have been pushing collective action at the Eurozone level and collective architecture. Thank you.
Thank you very much for that. Our panelists have been very generous with their intellect, with their honesty, with their time, since they have other things to do, but also with their restraint under my light whipping. I'm going to ask Jacob and each member of the Troika's representatives to make one final point that they wish to make, either in response to something or just something they didn't get the chance to say. And then, since Jean represents a troika of authors, Guntram and Andre, he gets to make 3 points as the final word. Jacob, very nice of you. York. Wow, this, I should call Ted back up. Okay.
I just made the 1 point I would have made.
Brilliant, Reza, you're a pro. Jean, last word.
Okay. First, on the premature character of the evaluation, we stick to early. It is early. It is fraught with all the difficulties of having an early evaluation, but I do think time has come to provide analytical elements to the debate that is there anyway. So better to base it on something serious, if not perfect, than on nothing or just prejudices. Second, on the methodology, we agree obviously that comparing forecasts with outcomes is of limited value in terms of information, but it does tell us something when you find systematic departures. When you find that what I said on exports, it's not a matter of the global environment having changed and your GDP is a bit lower, etc. It's something that tells you about the structure and the weaknesses, the initial weaknesses of the program. So that's what we're trying to do. We're not just giving grades about forecasting. That's not the purpose of the exercise. Third, on options available in real time. Well, some of those options were discussed in real time. The involvement of senior bondholder in the Irish case, that was discussed in real time, not least by the Troika institutions. The PSI, perhaps not at a very early stage, but it came at some point in the discussion. We say the response was late. I mean, that's not something that we exposed, just rationalized. That was also part of the real discussion. Finally, on the clarifications we propose of the role of the institutions and not a radical change, but the evolution of the role of the institution. I think one rationale is to go with the logic of the role they play. I could put forward another rationale, which is that it's the three institutions share the responsibility of something that could go right or deeply wrong. And at the time there's a failure, there's always a fight for who is responsible for it. And I think it's much clearer when they are clearly assigned responsibility, when you know exactly the role of each institution is playing, than in a situation where there is a lot of overlap and conflicts of interest and undefined responsibility. So I'm not saying it's pragmatically it was not the thing to be done. I think it was the thing to be done, but I think there is a case moving forward for clarification, and that's what we are advocating in the report.
Thank you all. I think you all agree this was an outstanding session. Represents in many ways the best of Bruegel between Guntram and Andre and Jean. I think they were brave and honest and fair in doing this report, and we're very grateful we had the chance to host them. I think it represents the best of the European institutions to have these people with us and the IMF, and I hope it represents in some ways the best of Peterson, that even when we're not selling our own wares, we provide the right kind of convening place for this kind of substantive, serious discussion. So thank you all very much, and again, congratulations to Jean.